Because of these activity on loans, because of these limits, banks saved hobby costs 6 and 12% and did not do lots commercial enterprise with the poor, who in a pinch took their valuables to the pawnbroker or the mortgage shop. But the deregulation of the banking region in the 1980s ushered the cash chargers again into the temple by way of cashing off strict usury limits. Interest prices quickly reached 300%, then 500%, then 700%. Suddenly, some human beings have been very involved in beginning organizations that lend to the poor. In current years, 17 states have added returned robust usury limits, capping activity fees and efficiently prohibiting payday lending. But the charge prospers in most places. The annual share fee for a 2-week $300 mortgage can attain 460% in California, 516% in Wisconsin, and 664% in Texas. About a third of payday loans are now made online, and nearly half of online borrowers have overdrawn bank accounts. The average borrower was in debt for 5 months and paid a fee of $520 to borrow $375. Of course, getting people into debt is the desired outcome for a payday lender. This is how they turn a profit of $15 into a profit of $150. Payday lenders don't charge high fees because lending to the poor is risky, and most lenders pay high fees even after multiple deferrals. Lenders blackmail because they can. Annually, nearly $11 billion in overdraft fees, $1.6 billion in check cashing fees, and $8.2 billion in payday loan fees. That's more than $55 million a day in fees, collected primarily from low-income Americans. And that does not even include the annual revenue collected from pawnbrokers, the title loan service, and rental programs with purchase option. When James Baldwin remarked in 1961 that poverty is expensive, he could not have imagined these recipes. We also need to expand housing options for low-income families. There is no one right way to do this, but there is clearly a wrong way. The way we have it now. One simple way is to strengthen our commitment to existing housing programs. Public housing provides affordable housing for millions of Americans, but it is woefully underfunded relative to demand. When the affluent town of Cherry Hills, New Jersey, opened applications for 29 affordable housing units in 2021, 9,309 people applied. Yet the skyrocketing demand should tell us something. Affordable housing is life-changing and families desperately need it. We can also pave the way for more Americans to become homeowners, an initiative that can benefit poor, working, and middle-class families, as well as countless young people. Banks generally avoid small mortgages, not because they are riskier. Such mortgages have the same delinquency rate as larger mortgages, but because they are less profitable over the term of the mortgage. $1 million in interest will earn much more than $75,000 in interest. This is where the federal government can step in and provide additional funding to build the ramp in homeownership. In fact, it's already doing this in rural America through its 502 direct lending program, which has helped more than 2 million families move into their own homes. These loans are fully guaranteed and managed by the Ministry of Agriculture, have low interest rates, and for many poor families cover the full cost of the mortgage with no down payment required. Last year, the average amount of 502 direct loans was $222,300. But the cost to the government per loans was only $10,370. A pittance for such a long invention. Expanding programs like this to urban neighborhoods will allow more low and middle income families to have their own homes. We also need to ensure fair access to capital. Banks must stop robbing the poor and near poor of billions of dollars each year and immediately stop charging exorbitant overdraft fees. As legal scholar Mahersa Batterson points out, When someone overdraws an account, the bank can simply freeze the transaction or clear the underfunded check, offering the customer a short-term loan with a low interest rate of, say, 1.0% per day. States should rein in payday lenders and insist that lenders make it clear to potential borrowers how much their loans will ultimately cost them. Just as fast food restaurants must now display calorie counts alongside burgers and milkshakes, payday loan stores must display the average total cost of different loans. When taxes passed disclosure rules, residents had far fewer bad debts. If Texas can do it, why not California or Wisconsin? However, to end financial abuse, we must expand, not limit, access to credit for low-income Americans. Some have suggested the government to step in and ask the USPS or the Federal Reserve to make small loans.